Stock of the day. I thought I'd bring up Growthpoint Properties because they updated the market saying it has seen a record increase in half-year portfolio valuation. The preliminary draft external valuations indicate the value of its industrial portfolio has increased by 146 million to $1.5 billion. That's almost 11% higher on a like-for-like basis than the prior book values. What did you think of the report? And yes, this was industrial property, but a lot of these companies are going to come up with revaluations.
Yeah.
And what are we looking for? Particularly the groups, REITs and property assets in commercial and also shopping centre. And this worries me a bit on how valuations are done.
Yes. Yeah, this is late cycle valuation.
Right.
So this is where you sell into that valuation because the numbers always going to look at the late cycle is going to look good as it gets. Now, look, a lot of these have turned around. Like if you're telling me industrial property is not good, you're about 12 months late.
Right.
Everyone knows.
Yep.
So they've done well. Look, I don't think there's anything wrong with them. I think they're quite solid. They've done relatively well. I think the cycle's turned around. I was actually talking to a few people today, just getting a grasp of, talking to clients from different backgrounds to get an understanding of how the flow of human capital back into the cities and so forth, public transport and so forth. Look, most of it's back up to 70-80%. Suburbs, when you look at shopping centres are really back up and running. You can't find car spots on the weekends.
Yep.
So it's all pretty okay. Its recovery is going well. My friends in small business, they're seeing the traffic. They're not buying as much, but it's definitely stepped up in the last couple of months.
Okay.
So there all seem to be numbers coming
So
through.
Growthpoint's in a sweet spot with industrial, isn't it? Of all the property areas.
I think, yeah, industrial, it's been the
done.
one, everyone's on it, and
Yeah.
I think they've done relatively
It's
well.
not just industrial. Growthpoint owns
Retail.
an office portfolio, so
Right.
the office portfolio actually increased too.
Right.
But a large chunk of this increase largely reflects shrinking cap rates. So that's just cap rates.
Right.
We don't want to get too technically, but think about that as the yield on your property investment. It's a function of interest rates. Interest rates fall, cap rates compress, valuations expand.
Right.
That's the relationship that's happening here, and it's
But
running
what if
through
rents
the
have
entire.
dropped?
That's
That plays into it as well.
it. Yep. And if your rents have dropped, then the multiple will multiply by the rent to give you your valuation.
Yeah.
But the multiple is actually expanding at the moment, and that's covering any shortfall in rent. So I think that's what's happening with the office at the moment.
Right.
And you don't have that problem in industrial. It's real valuation. They'll recognise this through their P&L.
Yeah.
They'll print a very good profit number. What's important to realise is that this does not turn up as cash. It can reverse if interest rates reverse.
Yep.
So it's low quality profit growth.
Right.
But I agree with Mathan. I mean, it shows you where we are in the cycle here, that low interest rates are having their impact, and the impact is significant across the property board.
Right.
We've been, as you know, we've been big fans of Brickworks for a long time,
Yep.
and Brickworks has a wonderful property business inside it, and the majority of profits in that property business comes from compressing cap rates, from interest rate movements, not from rent rises or
Right.
from redevelopment profits.
As long as interest rates are going your way.
Then property businesses do spectacularly well.
Right.
Yeah, but just be aware that the growth doesn't come through as cash. This is low quality growth that's recognised on the accounts, but doesn't fall through.
Right. Okay.
Yeah, this is, I mean, you look at the best of the breed is Goodman's, right?
Yep.
And that's trading at back to the all-time highs. And it's good, but even that's not worth for me where it is. You're paying too much. And Gaurav's right, it's a time where it's pricing in what's already happened. So you know interest rates were low. It's being held artificially low. I don't think that exists in 6 months' time. So if you're looking at 6 months, 12 months' time, either the yields stay where they are or they're going higher. If they're staying where they are, there's going to be substantial stimulus going through to hold it.
Yep.
But the reality is we're in an interest rate rising cycle. From here, banks have already pulled off, all their fixed rates have gone up, variables going to follow. So we're in that cycle. So if you're looking at 12 months, 24 months, that's going to rise. So these guys will reverse a lot of these things. So this is the time when you go, it's probably the end of that cycle. And so the smart money is probably getting out here and going into something else.
Yeah, but
And
you just don't know. I've stopped guessing where interest rates are going. I actually have no idea.
Yeah.
I would have expected, with the economy where it is, with the level of activity where it is, where company profits where they are, interest rates look absurd. They look absolutely silly. But then you've got the RBA and all central banks confirming that they're going to stay low for a long time.
Yeah.
I don't. What do you do with that?
There's
that's hard.
I mean, if this US Fed is doing 1.5 trillion dollars a year of bond buying, ECB is doing even more. Bank of Japan that's a Ponzi scheme. They just got to keep doing it and they just keep increasing. So if you put it into that context, just the three, ignore the Chinese. If you're looking at those three, you're looking at $4 to $5 trillion of bond buying every year. So the Fed is actually ramps up buying every data point that's going to spike inflations to keep the yield there. So the yield's been going sideways for a number of months. That's just because they're burning so much QE. The problem is, this is the beauty of the big cycle, and I always refer to cycles here. The big cycle is because you've reached that point where inflation's taken off, it's broken out, every time they act to hold the yield where it is, they expand their balance sheet. They expand their balance sheet, they depreciate the US dollar, which means the next lot of inflation number is going to be higher because everything input costs. They're in this trap right now. Just to hold the bond yields where they are, they're going to make inflation higher and higher. And they're not going to tell you that because that'll spook the market. So at the moment, they're just going, it's transitory, transitory. The only thing transitory is what they're doing because they can't keep doing it. So everyone knows that, but they seem to keep doing it. And especially when you see massive growth numbers, very good job numbers, all of those things are telling you that the economy is doing well. But at the same time, we still got emergency stimulus.
Yeah.
So I just don't think that's sustainable. Yeah, we might do it for another couple of months. 3 months, 6 months down the track, it just becomes a bomb.
Okay. So you're saying interest rates are on the way up, inflation's on the way up, and get out of real estate investment.
So this is not the problem. You've got to look at things that in 12 months' time, when this macro plays out, and it's inevitable, as it goes up, there are other sectors that will benefit out of it. And this is not the sector that
So
benefits.
get out of property into what?
If you're looking at it on valuation basis, I'm looking at insurance sector.
Oh, yeah, your ugly ducklings?
They are the ugly ones.
Right,
They
yeah.
come through. And the worst of the lot is QBE.
Yes, it is.
And it's breaking out. It looks really good. And numbers, and they've been given a pretty decent upgrade.
Every time someone says QBE, an analyst dies somewhere.
And actually, the funny part is, every time I tell any of my prospective clients and I mention QBE, I always remember a part of Gaurav just going pop.
I know. It's still raw for me.
Right,
it's about
yeah,
10 years ago.
Yeah, exactly. All right. So no for Growthpoint?
No, I'm probably a bit more circumspect than Mathan. I don't know about interest rates look silly, but the central banks are standing behind them.
Right.
It could stay this low for a while yet, and if they stay low, Growthpoint will do fine. Yeah.
Okay.